PFR Nation, it's Kevin Lau, your host of the Planning for Retirement podcast. And today I'm going to be breaking down the IRS. They just announced the updated tax brackets for 2025. And so I thought this would be a really good opportunity for me to explain a little bit at a very high level how the tax brackets work, not only for ordinary income, but also for capital gains, and also how the standard deduction works. I just definitely get a lot of confusion around this one from prospects and clients, and rightfully so. Our tax code is unnecessarily complicated, but it is what it is. And I thought this would also be a nice sort of teaser into next week, our podcast that's coming out. I just finished recording it. It's going to be coming out a week from today. So that will be Halloween, and that is going to be former President Trump versus VP Harris's tax policies and how they will impact you, PFR Nation. So you're not going to want to miss that. If you're interested in that one, make sure to subscribe to the channel so you don't miss out on it next Thursday. All right, without further ado, why don't we jump into the whiteboard? And so I did a couple of three screen grabs from the intranet. This was actually from the Tax Foundation website, taxfoundation.org. Phenomenal resource, by the way. If you like tax stuff, go to their website. They've got a bunch of information. They have blogs, they have content, podcasts. They've got a lot of good stuff in there. But as you can see, the 2025 brackets are updated here. Okay, so for ordinary income tax brackets, we've got this first little chart here. We've got the standard deduction updates on this chart here. And then we've got the capital gains, which is this third chart at the very bottom. And really, essentially, this is just an inflation adjustment. The tax rates did not change at this point in time. Now, if 2026 rolls around and nothing has changed in terms of the tax policies and legislation, the Tax Cuts and Jobs Act is sent to sunset at the end of 2025. So these brackets, these rates will revert back to the old brackets from 2017. And so just keep in mind, but I recorded this on my episode. I believe my prediction is the Tax Cuts and Jobs Act will get extended. Okay, that is my prediction. And if you want to hear why, make sure to stay tuned to that podcast episode. But as you can see, we've got three columns here. We've got the single filers here on the left-hand side. We've got married filing jointly, and we have head of household. I'm going to focus this one on the married filing jointly, folks, because that's actually an example I'm going to break down with a real-life client in just a minute here. But as you can see, our tax system is a tiered system, okay? And so I hear a lot about, hey, Kevin, I'm making, my wages are $180,000, so therefore I'm paying 22% tax. That's not necessarily true, and I'm going to break down that example in just a second. But the first $23,850 is going to be taxed at 10%. Okay, the next, we'll call it, what is that, about $73,000 roughly, will be taxed at 12%. And then the other, I don't know, maybe $50,000 for this individual will be taxed at 22%. And the reason I say 50 is because there is a standard deduction involved there, and that is illustrated here on this section. So the standard deduction, you can take, any taxpayer can take, if you're not itemizing your deductions. If you're itemizing your deductions, you're adding up things like SALT deductions, charitable deductions, medical expenses that exceed 7.5% of your AGI, et cetera, et cetera, et cetera. And if you add all of those up and you exceed these deduction amounts, let's say you're married and your itemized deductions are, let's say, $40,000, well, you will choose to itemize. So oftentimes you'll go to your CPA or tax preparer. They'll ask you for your all of your receipts and all of your deductions, your potential tax deductions, and they'll add those up, and they might decide, say, hey, you know what? Your deductions are only $20K. So therefore, it makes sense for you just to take the standard deduction because that's $30,000. That was one of the benefits of the Tax Cuts and Jobs Act of 2017, is that it doubled the standard deduction everywhere, okay, for everyone. But that's generally, sort of that standard deduction versus itemized. So even though you gave all of your receipts to your accountant, doesn't mean you're actually taking a tax deduction for those things. They're just trying to tally all of those up to see if they exceed the standard deduction, which 90% of taxpayers, 90% of you out there, PFR Nation, are likely taking the standard deduction, not itemizing. And one of the big things that's on the chopping block that I talked about in the podcast for next Thursday is going to be this potential uncap for the SALT deduction. So make sure to check that out. Okay, so that's so that's the gist of the income. So, just because you're making 180 or let's say 250 doesn't mean all of your income is taxed at that rate. It's going to be a blended system, and then you'll come up with an average tax rate. So I'll show you how that's calculated here in just a second. But what's included up here in this income, it's things like wages, bonus, rental income, Of course, business income. Let's see what else. Short-term capital gains. What else? What else? Oh, interest income. That's a big one. Okay, interest income. So that's like interest from a CD or a bond that you might own. And this is why I kept getting on people over the last couple of years. They were chasing short-term yields with long-term dollars. They were panicking about the stock market in 2022. Consumer confidence was at an all-time low in July of 2022. And I told y'all, I said, listen, stay patient because typically when consumer confidence is low, stock markets return very strong positive performance over the next 12 months. That happened in 2023. It's happening again in 2024. But the problem is a lot of people were chasing short-term yields. They were sitting in a CD or money market account earning 5%, feeling very, very good. But maybe that was $200,000 in a high yield savings account earning 5%. What is that? 10 grand. You're now adding that to ordinary income and it's going to be taxed at your marginal rate. So one of the most inefficient things you can do on your balance sheet is chase short-term yields with long-term dollars. Of course, if it's your emergency fund money, if it's money you're going to need in the next, let's say 6 to 12 months, large purchase, whatever it might be, a new boat, REV, of course, keep that in a high yield savings account. Do not risk that in the stock market. But if it's long-term, your retirement, don't do that. Okay. And taxes are a reason why, or one of the reasons why I should say. Okay. So the standard deduction, you basically just take that off the top of any income you earn, any ordinary income you earn, you take that standard deduction off the top. And so really what's going to fill these brackets is your taxable income. All right. So we'll just go over that again in just a second. And then the other change here, and again, obviously all of these numbers were just simply adjusted for inflation. Like married filing jointly, the standard deduction was 29,200, so a slight increase there, for 2025. And then this last chart here is for capital gains. This is the one down here, and essentially we've got three tiers at this point in time. We have 0%, 15%, and 20%. Now this one's a little different. This one is not only including your ordinary income taxes, but also any other income like a long-term capital gain or qualified dividends. Okay. Oh, that's another thing that's included up here is non-qualified dividends. Sorry for my handwriting. It's brutal. You've heard me say this before. I apologize in advance, but that says non-qualified dividends. Okay. So you add up everything. You add up all of your income sources. You subtract out your deductions, whether it's the standard or the itemized, and you're going to fall somewhere in these categories. And if you're married filing jointly down here, or let's say you're making less than 96,700, you're in the 0% capital gains rate. Let's say your total income, your total taxable income is, let's say, $60,000. Maybe you just retired and maybe your taxable income went down to zero and you're not even taking Social Security yet. Maybe you've got a pension. Maybe you're taking some distributions from a retirement account. Maybe it's $60,000. Well, you've got some room there up until you hit this 15% tier where you might consider capital gain, tax gain harvesting. Harvest those gains at a 0% rate. And that way you don't pay any taxes on those gains and reset the cost basis or use that for income. And it's also a great way to keep your income low for things like ACA subsidies or even your Medicare premiums. Now, the next tier up is the 96,700 up to 600,050. Again, married filing jointly. So if your taxable income, again, is between these two numbers, you'll be at the 15% bracket. If it's above 600,050, you will be taxed at 20%. Plus, there is a net interest income tax, about 3.8%. So you'll be really at the 23.8% capital gains bracket. Okay. Now, there are some proposals on changes on this one. So really, again, stay tuned for the podcast episode next Thursday. You're not going to want to miss that one. But this is how the capital gains work. So this is a very favorable. I mean, you compare this 15% here to, let's say, 20%, which is what this client is going to be in. That's a substantial little arbitrage there. That's the benefit of investing in securities inside of a taxable brokerage account. That's outside of your IRA. Of course, max fund those qualified accounts, max fund those tax advantage accounts for you. But then any excess savings, a great way to buy those securities is just inside a plain old taxable brokerage account. So you've got the long-term capital gains treatment and you've got the treatment of step up and cost basis. So a lot of value there. But that's the general kind of the lay of the land of what has changed. Now, how does this actually work? Let me break down a real client example of a client that we're working with. This individual is 62. His wife is 60, I think about the same age. She might be 63. They are married, filing jointly. He has wages in the amount of 180,000. Okay. And he also has capital gains in the amount of 20,000, and all of his dividends are qualified. They're all from qualified stocks that pay quarterly dividends in the amount of, let's call it roughly 7,000. These are rough projections at this point in time for 2025 because we're just playing hypothetical here. So if you add those three numbers up, we have a total income equals 207. Okay, so that is their total income, adjusted gross income. Okay, now this individual is contributing to a 401k plan, so this 180 is net of that. So just an FYI, just letting you know that absolutely that deduction from the 401k from qualified accounts will come prior to them hitting the tax bracket. So that's the benefit of contributing to this qualified plan. So this 180 is net of a $30,500 401k contribution. But total adjusted gross income about 207. Now, if we subtract out their standard deduction, which they will take, of $30,000, now their taxable income is, 177K. Okay, so that's their taxable income number. But here, let's watch, and that's gonna matter when it comes to the capital gains tax. But here, let's start with income taxes. How is this going to break down for this couple? Okay, so we've got this 10% bracket. All right, and let me sort of, I'm going to, let me make that a different color. Let's make this red. So we've got the 10% bracket here, and their range is from 0 to $23,850. So they will max that one. Okay, so they are going to max fund that particular one. Okay, and so we'll put income here. So they will max 23,850. Then we've got the 12% bracket. And that is, they will fill that one up as well. So we've got 73,000, the next 73,100. They will have that income, 73,100. And then in the 22% bracket, see that big jump there? So I kind of look at this as like bunches. We've got this 10 to 12, which is sort of one bunch, the 22 to 24, which is another bunch, and then these higher income tax brackets here. So I definitely look at that when we're doing tax planning for clients, is seeing, hey, can we push you to from 22 to 12? Because now then your interest income or your non-qualified dividends or other income sources are going to be taxed at a lower rate, which is valuable. All right, so 22%. I cheated a little bit, did a little calculation on this one. They're going to have an additional 53,050 in this particular bucket, because this one goes up to 200 from 96,000 up to $206,700. So they're going to have 53,050, and that's a total income of about $150,000. Okay, so why 150? Well, we already looked at wages. This is their taxable income, ordinary income, minus the standard deduction. That gives them this number. This is the number that's going to be fed through these particular brackets. Okay, so if we just do some quick calculations in this one, here, we'll draw a little arrow, they're going to pay tax of about 2,385. I'm sorry, 2,385. 2,385. For this 12% bracket, they're going to be paying 8,772. And then for the 22, they'll be paying 11,671. I just simply took these percentages, multiplied it by the income that's going to be fed through those brackets, okay? And then boom, now we've got a total tax of 22,828. Is their total tax. Okay, and we're going to come back to that number in just a second. Okay, so that's the income tax piece. Now, what about the capital gains? Okay, so we just looked at their income tax bracket and we just noticed that, okay, so 0% is for married filing jointly, anywhere from $0 up to $96,700 of total taxable income. Okay, so that's very key. They are in excess of that. Their total taxable income, like we just mentioned in the last slide, is in fact 177K. Okay, that's that 207 number, that adjusted gross income number minus the standard deduction. So in the 15% bracket, we have this 96,700 up until 600,050. So for this one, we know they're going to be in that 15% bracket. That's how the capital gains works. If you're in those tiers, those ranges, you will pay 15% on any capital gains. And we just went to that last slide. Capital gains, a sale from an investment plus qualified dividends, which are also treated as long-term capital gains. That's a key. When you're investing in a taxable account, make sure you load up on this good stuff here. The taxable in the taxable accounts, you want qualified dividends where possible. Obviously, you don't want to let the tax tail wag the dog. If you need other investments in there for diversification to align with your risk tolerance and your time horizon, don't let the tax tail wag the dog. But we've got $27,000 of total income that's going to be fed through this. And so if you multiply that by 15%, that's a tax of $4,050. And if you add the income tax, which we just looked at, to 22,828, their total tax is 26,878 would be their total tax bill. If we divide that into their total income, their total adjusted gross income, 207K, what do we get here? 12.98%. This would be their average tax rate across the board with all income sources. So just because this individual is technically in the 22% bracket doesn't mean all of their income is taxed at 22%. It's a tiered system. Some is ordinary income, some is capital gains, qualified dividends versus non-qualified dividends. All of this factors in to our really complicated tax code. And so I apologize to you, the consumer, about this complexity, but this is what we have to deal with. But here's the opportunity that I see with this individual. Okay, so we've got this taxable income, this total income of about 207. I'm sorry, taxable income of about 150. We've got room here. We've got probably another, I don't know, 50 grand or so until we hit that next tier. Maybe it makes sense for them to do a Roth conversion. Maybe it makes sense for them to flip into after-tax contributions versus pre-tax contributions. There's so many factors that play in there to sort of look at that next bracket before they get to that 24% bracket to take advantage of. And again, we know these brackets are low now. We don't know how long they're going to stay this low. So looking for planning opportunities based on what we know is the way to go. So I hope you all found this helpful. PFR Nation, average rate, we just hit this 12.98%. And so I hope you all found this helpful. If you did find it helpful, make sure to like this video, make sure to share it with a friend or family member or colleague, and make sure to subscribe to the channel. You don't want to miss these fireside chats, but you also don't want to miss our podcast on a go-forward basis. Until next time, everybody, Kevin Lau signing off.